Welcome back, everybody, for another deep dive. This time we're exploring ways to build generational wealth through real estate investment.
Generational wealth, yeah.
More than just, retiring comfortably, but really setting your family up for success down the road for generations to come. We want to get right into the strategies. You guys are here to learn how to get started.
Yeah.
Thankfully, we have insights from a real estate expert to help us.
And this expert doesn't just talk about any property.
Right.
They really focus on strategic approaches,
Yeah.
ones that can make a real difference.
And the first one that really jumped out at me, I'll admit, before reading this, my knowledge was pretty limited,
Yeah.
was real estate syndications.
Oh, yeah. Syndications.
Have you,
They can be a little complex sounding
Yeah.
at first, but really,
Yeah.
it's a group of investors.
Okay.
So these limited partners
Mm-hmm.
pool their money together to purchase something big,
Okay.
like a big apartment complex or something. They rely on general partners, folks who are experienced, to manage it and make the decisions.
So it's like a team effort in real estate.
Yeah, exactly.
The general partners bring the expertise and the limited partners bring the capital.
Yeah.
Is that kind of how it works?
Exactly. And this expert actually gives an example of a syndication
Oh, wow.
where investors saw an 8% annual return for 5 years, plus a 50% profit share when they sold the property.
Okay.
So imagine nearly doubling your initial investment.
Wow, those are the kind of numbers that make you sit up and take notice.
Right.
But I'd be lying if I said I wasn't a little wary. What are some things investors should watch out for with syndications?
You always want to be cautious, especially with big money.
Right.
But one thing to really look at is the general partner's experience.
Okay.
Have they managed similar properties before? What were the returns like for their previous investors? Those are big questions.
So really do your due diligence,
Oh, yeah.
researching those general partners.
For sure. And, those potential returns might sound amazing,
Yeah.
but you got to remember, no investment is entirely risk-free.
Right.
The real estate market.
Yeah.
It goes up, it goes down, interest rates change. There could be all sorts of challenges with any property.
That's a really good point. Even with great general partners, there are still those outside factors,
Yep.
that can really impact the investment. So, syndications, they could be lucrative,
Yeah.
but it's not a path to take lightly.
Yeah, you really got to go in eyes wide open.
Absolutely. Now, some people, they want to be more hands-on, right? They like
Mhm.
syndications, but maybe they want a little bit more control and connection with their investments.
Yeah, and for folks like that, multifamily properties are often a popular choice.
Okay.
Think apartment buildings.
Yeah.
With 4 or more units, it's a solid avenue, a lot of people say, for generating passive income.
And I can definitely see the appeal there, right? Compared to, say, a single family rental. If one person moves out, you've still got income coming in.
Exactly. You're not putting all your eggs in one basket with one single tenant.
Diversifying.
Right.
That sounds great. Now, are there any downsides to multifamily versus single family? I imagine, managing a big apartment building has got to come with its own set of challenges.
You're right. There's definitely more management involved.
Right.
More tenants, more potential for maintenance issues. The financing can be a little trickier. It's not just collecting rent checks.
So more potential income, but also more responsibility.
Yeah, exactly.
Okay.
And a lot of people talk about passive income with multifamily, and that can be true, but being a landlord, even with a property manager, still takes work.
Good to know. You
Yeah.
got to go in with realistic expectations.
Mm-hmm.
Now I'm realizing there's no one-size-fits-all approach to real estate investing, huh?
No.
It's about your own individual goals, your risk tolerance, and how much you can actually afford to invest.
And speaking of different approaches, let's talk about real estate investment trusts, or REITs.
Okay, REITs. I've heard that term before.
Yeah.
But I'm a little fuzzy on the details.
Basically, REITs are like companies,
Okay.
public traded companies, actually, that own and manage buildings that make money,
Okay.
like shopping malls or office buildings. So instead of buying the property yourself, you buy shares in the REITs, like you would invest in the stock.
So you can still tap into the real estate market
Yeah.
without all the hassle of actually owning and managing the property?
Exactly. And that can be a real draw.
Okay, yeah. But how do the returns on REITs compare to, say, those syndications we were talking about before?
Well, REIT returns, they tend to be more in line with the stock market,
Mhm.
kind of like your average stock. Syndications, on the other hand, with that rental income and property appreciation, they might have higher returns. but with higher returns often comes higher risk.
So REITs are more of a slow and steady, and
Yeah.
syndications are more like swing for the fences?
Yeah, I like that analogy.
Okay, cool. You mentioned diversification with REITs. What exactly does that mean for REIT investing?
There are actually different kinds of REITs, each one focusing on different types of properties. You got equity REITs, which own and operate properties like malls and offices.
Yeah.
And then there are mortgage REITs, which provide financing for real estate projects and earn income from interest payments. And then there are even hybrid REITs, which are a mix of both.
Wow, I had no idea. There are so many different flavors of REITs out there. So if I wanted to explore REITs further, where do I even begin?
Well, the great thing is they're traded on public stock exchanges.
Okay.
So you buy and sell them just like any stock.
Yeah.
And that makes it pretty easy to start, even with a smaller amount of money.
So that's a much lower barrier to entry than, say, buying a multifamily property.
Definitely. And you can even find REIT ETFs.
Oh, okay.
Those are like baskets of REITs,
Oh, okay, I see.
to give you even broader diversification.
Okay, I see. So REITs are a valuable tool for building a diversified portfolio, especially as your wealth grows.
And as you get more comfortable with real estate, you can dig deeper into specific types of REITs,
Right.
or even pick individual REITs that match your goals.
REITs, a whole world to explore there. Now, I'm guessing our real estate expert has even more for us than just these three strategies.
They do. And this one captures the entrepreneurial spirit, I think. It's called the BRRRR method.
The BRRRR method. Okay, break that down for me.
It stands for buy, rehab, rent, refinance, repeat.
Okay.
It's about finding these undervalued properties, the ones needing a little love.
Okay.
You fix them up to increase the value,
Okay.
rent them out for cash flow, and then use that increased value to refinance.
Okay.
And then you do it again with another property.
Okay, let's unpack that a little. So first,
Yeah.
you buy. What kind of properties are we looking for here?
We're looking for diamonds in the rough.
Okay.
You know, the properties that are structurally sound, but maybe they've got some cosmetic issues.
Okay, yeah.
Like an outdated kitchen, peeling paint, that kind of thing.
Yeah.
Those things turn buyers off, so the prices are lower,
I see.
but you can come in and fix them up.
So it's not about buying a move-in ready property. It's about seeing the potential.
Exactly. If you can make the right renovations, you can boost the value significantly. And that's where rehab comes in.
Right.
That's the second step.
Okay. So you're basically taking this neglected property and giving it a makeover so people want to rent it.
Yeah.
But renovations can get pricey, right?
Yeah, for sure.
How do BRRRR investors typically pay for those?
That's a good question. Financing is really important with this method.
Yeah.
Some investors use their savings or maybe a private loan.
Okay.
Others go for hard money loans. Those are short-term, higher interest, but designed for these projects.
Okay, so they give you that upfront cash to get the work done.
Right.
Then what? Let's say the rehab is done, the place looks great. What's next?
That's when you move on to rent.
Okay.
Find a good tenant, get that rental income coming in to cover the mortgage and other costs. That cash flow is key.
Okay, so now we're making money. But the BRRR method doesn't stop there, right?
Yep. Still got refinance and repeat.
Right.
Yeah.
Okay, so what happens next?
This is where it gets interesting. That renovated property, it's worth a lot more now, right?
Yeah, hopefully.
So you refinance, taking advantage of that equity you've built.
So basically, get a new loan for the higher amount.
Exactly. And often, with the right refinance, you can actually take out some of that equity in cash.
Oh.
So now you've got this chunk of change from the refinance.
Right. What do you do with it?
Time to repeat. You take that money, use it as a down payment on another property,
Okay.
and start the whole process over again. Buy, rehab, rent, refinance, repeat. You're scaling up your portfolio.
Like a snowball effect.
Yeah, exactly. It's a system for growth in real estate.
This all sounds amazing, but I gotta ask, are there any downsides to BRRRR? Anything investors should be careful about?
Well, like any strategy, it's got its challenges.
Right.
Sometimes people overestimate those renovation costs
Yeah.
or how long it'll take to finish them.
But that makes sense.
Delays can happen.
Right.
So it's important to have a good plan, a realistic budget, and reliable contractors.
Yeah, you don't want surprises popping up.
Nope. And remember, things like property taxes and insurance, those can add up while you're waiting for a tenant.
So this isn't just a passive thing. It takes work.
It definitely does.
Planning, research, getting your hands dirty.
And remember, BRRR relies a lot on being able to refinance at a good rate.
Right.
So you need good credit and a good relationship with a lender.
That's a really good point. Your financial health is a big part of this.
All right, let's take a step back and look at everything we've talked about today. syndications, multifamily properties, REITs, and the BRRR method.
Yeah.
That's four very different approaches.
It's like having a whole toolbox full of options.
Exactly. Each one has its own strengths and weaknesses.
So it's not about the best strategy, it's about the right one for each person.
Exactly. You got to find what works for you, your goals, your situation.
Right.
And that's why I think this deep dive is so useful. It's about giving you the knowledge to make good decisions about your investments.
We've covered a lot of ground. The potential of syndications for passive income, the stability of multifamily properties, the accessibility of REITs, and that entrepreneurial BRRRR method.
A lot to digest.
Yeah, it is. Don't feel overwhelmed. Think about which one really sparked your interest.
Yeah. Which one stood out to you? Which one could you see yourself actually using?
Maybe you already knew about some of these and now you're ready to learn more, refine your strategy.
Exactly.
This deep dive, it's really just the beginning. It's a jumping off point to keep exploring.
Right.
I know it can feel overwhelming at first.
Right.
Like, where do you even start?
Yeah. Especially when you're just starting out.
Especially, yeah.
But the thing is,
Yeah.
you got to break it down into smaller steps.
Right. Don't try to figure everything out at once.
Exactly. Pick one step and focus on that.
So you're really interested in REITs.
Yeah.
What could a good first step be?
Well, you could read a book on REIT investing. Or maybe go to a real estate meetup, Talk to some people who've done BR investing, get their advice.
There's so much information out there. Online courses, even podcasts like this one.
Exactly.
You just got to find what works for you.
And don't forget about mentors.
Oh, yeah, good point.
Someone who's already successful in the area you're interested in.
Right.
They can give you amazing advice.
It's like having a guide, right?
Yeah.
Someone who's already walked the path.
Yeah, exactly. They've learned the lessons.
And they can share those with you.
And building generational wealth, it's not a solo mission.
Right.
Find people who are on the same journey.
It's a team effort.
Yeah, like a real estate investment club.
Right.
Or even just some friends who are into financial freedom.
Yeah, having a supportive network is so important.
Definitely.
Yeah.
Keeps you motivated,
Yeah, absolutely. So as we wrap up, I want to leave you with this. Building generational wealth through real estate, it's not just about the money.
It's so much more than that.
What do you mean?
It's about creating a legacy.
Okay.
Financial security for your family.
Right.
Teaching your kids and grandkids to be smart with money.
Breaking those cycles of financial struggles.
Exactly.
Giving them the tools to build their own future.
Imagine your family, going to college without debt.
Yeah.
Or starting their own businesses, traveling the world, having the freedom to pursue their dreams.
That's a really powerful vision.
And it can be a reality with real estate investing.
It's like planting seeds that will grow into a forest.
I like that.
Of abundance for generations to come.
So as you continue on your journey, remember this. Building generational wealth, it's a marathon, not a sprint.
Right.
There'll be challenges.
Yeah, for sure.
But keep going, keep learning, and you can create financial freedom for yourself and your loved ones.
Awesome advice. Well, folks, there you have it. 4 powerful strategies for building generational wealth through real estate. Syndications, multifamily properties, REITs, and the BRRRR method. Pick the one that resonates with you, start taking action, and remember, we're all in this together. Until next time, happy investing.